I want you to imagine you just hit, like, a game-winning home run.
Oh, best feeling in the world.
Right. Bottom of the ninth, the crowd is going absolutely wild. You cross home plate, and then your coach immediately benches you
Wait, what? Why?
because you didn't hit the ball quite far enough into the upper deck. I mean, it cleared the wall, but it just wasn't, majestic enough.
That makes absolutely zero sense in baseball.
Exactly. It makes no sense in sports, but in the stock market. It happens literally every single day.
Yeah, it really does.
And today, we're taking a deep dive into a company that just posted these massive double-digit growth numbers, only to have Wall Street instantly wipe billions of dollars off its market cap.
It is honestly one of the most frustrating dynamics for anyone managing their own portfolio. I mean, you do your homework, right?
Yeah.
The company does exactly what it's supposed to do, and you still get punished for not being, utterly flawless.
Welcome to today's deep dive. We are unpacking this fascinating and, frankly, kind of maddening contradiction in the market right now. And we're using Costco as our real-time case study today.
Costco Wholesale Corporation, yeah, a perfect example of this.
So here is the setup for you. In July 2026, Costco reported their June sales numbers, and they revealed a staggering 10.6% rise in sales.
Which is massive.
Right. That signals incredibly strong consumer demand. You would assume the market would be, throwing a parade for them.
You'd think so, yeah.
Instead, the stock immediately tanked by over 4%. So our mission today is to help you understand how a company can post phenomenal growth, still get taken to the woodshed by traders, and whether this drop represents like a glaring red flag or a rare buying opportunity.
Yeah, and to really grasp what happened here, we have to talk about the invisible expectations that were already baked into the stock price.
Because it's never just about the raw numbers, is it?
Exactly. The market doesn't trade on the present, it trades on the future. And sometimes it demands a future that is just mathematically exhausting to maintain.
Let's explore that, because a 4% drop on double-digit sales growth feels like a total glitch in the matrix. I mean, the financial media keeps throwing around this phrase, priced for perfection.
Right, you hear that a lot.
What are the actual mechanics behind that paradox?
Well, it fundamentally comes down to valuation colliding with sentiment. The stock recently experienced what institutional traders call a localized capitulation.
Localized capitulation.
Yeah, it gapped down $40.16 in a single session.
Wow.
Yeah, it landed at $912.97.
Wait, so localized capitulation, does that mean the sellers in this specific stock just sort of threw their hands up and surrendered, even while the rest of the broader market was perfectly fine?
That is the perfect way to describe it. It was completely isolated selling pressure.
Interesting.
And the narrative driving this sudden drop is that Costco, at its current price, has absolutely zero room for error.
Because of the valuation.
Exactly. Before this drop, the stock was trading at a trailing price-to-earnings ratio, a PE of 46.14.
Okay, let's pause on that number for a second. A PE ratio over 46 for what is essentially, a giant concrete bulk grocery store.
It sounds wild when you say it like that.
Doesn't that mean investors are paying, like, Silicon Valley hyper-growth tech premiums for a company whose main innovation is selling oversized jars of mayonnaise?
I mean, yes.
Because paying 46 times a company's earnings for a traditional retailer is usually a recipe for total disaster.
It sounds absurd when you frame it around groceries, absolutely. But investors are not paying that premium for the mayonnaise.
Right.
Or the rotisserie chickens, or the massive packs of paper towels.
Right.
They are paying a premium for the absolute durability of the membership model.
But if the model is so durable, why the sudden panic? Because the headlines are incredibly bearish right now. They're all focusing on Wall Street's whisper expectations not being met.
The whisper numbers, that is the crux of the whole issue right there.
Explain those, because they drive retail investors crazy.
Whisper numbers are these unofficial, behind-the-scenes forecasts passed around by hedge funds and institutional analysts. They don't rely on the public guidance the company actually gives.
So what are they looking at?
They use alternative data, things like satellite imagery of Costco parking lots, aggregated credit card data, supply chain channel checks.
So they're literally counting cars from space.
Exactly. And their internal models suggested growth should have been even higher than that 10.6%.
Which is just a crazy expectation to begin with.
Right. So even though a 10.6% sales jump is objectively fantastic for a company of this sheer size, it missed that invisible hyper-bullish target they had set in their heads.
So the headline screams sales are slowing, but the reality is just, well, Sales didn't beat our secret unrealistic target,
Exact.
which explains why, if you look beneath that noise, the big institutional players like Bank of America, they're stubbornly maintaining their buy ratings on the stock.
Oh, yeah. Institutional money still entirely believes in the long-term runway of the business.
They're not spooked by the miss.
Not really. They know that a PE of 46 isn't valuing a grocery store. It's valuing an incredibly sticky recurring revenue engine.
Okay, so if the underlying business model is what justifies that massive premium, let's look under the hood.
Yeah.
What makes Costco's fundamental economic engine so different from, say, a traditional supermarket?
Well, if we look at the trailing 12-month metrics, revenue growth is a robust 9.23%.
Which is great.
And earnings per share sits at $19.88. And that growth is entirely driven by two very specific things: warehouse traffic and membership renewals.
I want to push back on their profitability for a minute, though, because I think this confuses a lot of people when they first look at Costco's financials.
Oh, the margins.
Yes, they operate on incredibly thin margins by design. We were talking about a 12.88% gross margin and a 3.01% net margin.
It is razor thin.
A 3% net margin sounds like they are literally one bad quarter away from disaster. I mean, if supply chain costs spike even a little bit, doesn't a margin that small mean they immediately start losing money?
That is the most common critique from traditional retail analysts, right? But it fundamentally misunderstands the mechanism of the business.
How so?
Those low margins on goods are a feature, they're not a bug. They strictly cap their markups on branded goods at 14%.
Only 14%?
Yeah, and for their in-house brand, Kirkland's signature, the markup is even lower than that.
So a 3% net margin isn't some tightrope they're nervously walking. It's more like, it's like a toll booth.
A toll booth, I like that.
Yeah, like they don't care about making a massive profit on the individual cars driving on the highway, the groceries. They just want to make sure millions of cars are paying that yearly toll to access the road in the first place.
That is an excellent analogy. They actively choose not to make a meaningful profit on the items they sell, specifically to create extreme customer switching costs.
Right.
Because they sell the goods essentially at cost, the psychological and financial commitment of that annual membership fee ensures you keep coming back.
Just to justify the upfront expense of the card in your wallet.
Exactly.
Does that mean they are intentionally capping their profits to starve out competitors? Almost like the Amazon model.
That is exactly the mechanism.
Right.
And it creates this brutal negative feedback loop for competitors like Walmart, Sam's Club, or BJ's.
Walk me through how that actually works in practice, though.
Okay, let's say Costco wants a cheaper price on 1 million units of paper towels. The supplier basically has to say yes, because losing Costco's volume would completely devastate their own factory's efficiency.
Right, Costco is just too big of a client to lose.
Exactly. So Costco secures that massive discount. But instead of pocketing that extra margin to boost their own quarterly profits like a normal retailer would,
They give it away.
yes, Costco takes those savings and passes them entirely to you, the consumer.
Which just reinforces the perceived value of the membership. You see the price drop and think, wow, this membership is totally worth it.
Precisely. And that drives more people to buy memberships, which gives Costco even more scale, which forces supplier prices even lower.
It's an unstoppable flywheel.
It really is. The high-margin recurring membership fees are the true profit engine. That money drops almost entirely directly to the bottom line.
And you can see the result of that flywheel on their balance sheet. I mean, they have a $407.8 billion market cap, an A-tier credit rating, historically low debt, and just massive free cash flow.
Huge amounts of cash.
And that cash is funding dividends, share buybacks, and over $3.4 billion in annual physical expansion.
It is a cash-generating fortress. It's completely insulated from the traditional retail wars.
So if the business model is literally designed to be a fortress, and the institutional money obviously knows this, why are we looking at a 16% haircut on the chart right now?
Well,
Let's decode the actual technicals, because knowing it's a great company doesn't help you much if you buy it at the exact wrong time.
right. The technical structure right now is telling a very specific story of institutional rotation. The stock currently sits 16.7% below its 52-week high of $1,096.50, which it hit back in May 2026.
But it is still firmly above its 52-week low, which was $844.06.
Yes, exactly. So if we look at the 13-week return, we do see a contraction of nearly 10%, but the broader macroeconomic uptrend is still totally intact.
The long-term trend is fine.
Yeah, the year-to-date return is positive, sitting at plus 5.87%. The most revealing metric right now, though, is the volume. Momentum is experiencing a major volatility flush.
Okay, let me translate that for a second. A volatility flush basically means all the weak hands.
Yeah.
You know, the short-term traders who got spooked by the scary whisper number headlines are rushing for the exits at the exact same time.
Yes,
And that drives the trading volume way up.
exactly. The 10-day average volume is currently 1.5 times the 3-month average.
But wait, how can you possibly know it's just short-term retail traders panicking and not, like, smart money dumping their shares?
You have to look at.
Because if volume is 50% higher than average on a downward move, my first instinct is that insiders and institutions know something terrible that we don't.
Well, you look at the insider transaction data for that. If the ship were actually sinking, the executives would be the first to secure lifeboats, right?
Yeah, sure.
But over a 90-day period, insiders sold a net of only 885 shares.
Wait, 885 shares total.
Total.
For a $400 billion company, that is statistically zero. That's like one executive buying a new boat.
Exactly. It is absolute silence from the insiders. There is no bearish cluster of executives abandoning ship.
Okay, that is reassuring.
So if insiders aren't selling and retail's out there panicking, who is buying all that elevated volume? High volume pullbacks in structurally sound companies almost always indicate institutional absorption.
Meaning the big hedge funds and pension funds are basically just sitting at the bottom of the order book with a giant net, quietly scooping up all those discounted shares from the retail traders who panicked over the whisper numbers.
You nailed it. They are buying a fortress at a 16% discount from the highs. And right now, the stock is testing technical support right near $900.
Why does that $900 level matter so much psychologically to a trader?
Well, it is a major round number psychological barrier for one, and it aligns with previous historical buying zones.
So it's a proven floor.
Right. If we see a sustained hold there, where the price simply refuses to drop further despite bad headlines, it forms a structural base, what technicians call a double bottom.
It essentially proves that sellers are totally exhausted and the buyers have established a firm line in the sand.
Yes. And once that base is built, it sets the stage for a mean reversion move.
Where the price naturally gravitates back toward its historical averages.
Exactly, pushing back up toward the $950 resistance level.
Okay, so if institutions are indeed quietly absorbing this dip and setting up a base, they must be looking forward to a trigger event.
Oh, absolutely.
What are the hidden levers and future catalysts that will actually force the price back up?
We are tracking 3 main catalysts on the horizon. The first is a technological update. Costco has finally launched a new digital wallet in its mobile app, which allows members to link their Visa cards for faster in-store checkout.
I mean, I see the logic of modernizing, but let's be real, it is 2026. Every independent coffee shop on my street has an app that takes mobile payments. How is catching up to a decade-old technology a serious catalyst that's going to move the needle for a $400 billion titan?
I know it sounds entirely underwhelming on the surface, but you have to think about the physical math of a Costco warehouse. It is all about the concept of throughput.
Explain throughput in this context.
Think about a warehouse on a busy Saturday afternoon. The aisles are packed, but the absolute bottleneck of the entire operation is the cash register line.
Oh, it's a nightmare. The receipt checker's alone at the door, but yeah, the registers take forever.
Right. You can only physically fit so many people in the building. By rolling out a digital wallet and reducing the friction of payment by even, say, 10 or 15 seconds per customer.
You are materially moving more people through that building faster.
Yes.
Oh, the compounding math on that is wild. Saving 15 seconds across millions of transactions.
When you operate at Costco's massive scale, shaving seconds off a checkout process is a hidden margin lever. It literally increases the operational and revenue capacity of every single store globally.
Without having to pour more concrete to build bigger stores or hire extra cashiers.
Exactly. It is pure operational efficiency dropping straight to the bottom line.
That is a phenomenal insight. It's not about the flashiness of the technology. It's literally just about the velocity of the carts leaving the store.
Exactly.
What is the next catalyst?
Fiscal Q4 2026 earnings are due in early to mid-September. And this is going to be the ultimate proving ground.
To see if the June numbers were a fluke.
Right. The institutional money will be watching closely to see if that June slowdown against the whisper numbers was just a transient blip or the start of a structural trend.
And if it was just a blip,
then that priced for perfection anxiety evaporates entirely and the multiple expands again.
makes sense. And the third catalyst?
Macroeconomic tailwinds. We are looking at potential Federal Reserve rate cuts on the horizon.
Which changes everything for retail.
It really does. If rate cuts materialize, borrowing gets cheaper, and consumer discretionary spending typically expands. High traffic, value-oriented retailers like Costco capture a massive share of that unlocked spending.
Plus, there's a broader sector rotation happening in the market right now, isn't there?
Yes, there is.
So institutions are taking their profits from the heavily overextended AI and tech stocks, but they still want growth. So they park that cash in a safer consumer staple hybrid like a membership club.
Precisely. As tech multiples get stretched to their breaking points, capital naturally rotates into places where the cash flow is practically guaranteed by subscriptions.
That paints a very bullish picture. But,
Yeah,
if I'm an investor looking at this, I need to know what happens if things go wrong.
of course.
Let's explore the bear case. If these catalysts fail, what actually breaks the stock?
The primary risk, hands down, is multiple compression.
Let me break down the math on multiple compression for a second, just so we are all on the same page.
All right.
If the market suddenly decides Costco shouldn't trade at a premium of 46 times its earnings, but instead decides it should trade at a normal retail multiple of, say, 30 times its earnings.
Yep.
Even if the company makes the exact same amount of money tomorrow, the stock price crashes. The market is just willing to pay less for the exact same dollar of profit.
That is exactly how it works. And as we saw with this recent 4% drop, when a stock is priced for perfection, any future deceleration in comparable sales, even a slight miss, can trigger that immediate, brutal, multiple compression.
It's a steep cliff to fall off.
It is. The market simply will not pay a 46 times premium for a company whose growth narrative is slowing.
What about the macroeconomic risk? What happens to the actual consumers walking the aisles if inflation spikes again or the job market weakens?
That's the second major risk, a consumer trade-down dynamic. Even Costco's value proposition can get squeezed in a harsh recession.
But wouldn't a terrible economy send more people rushing to Costco to save money on bulk items? I feel like that would help them.
It would absolutely drive foot traffic. More people would go to the store, yes. But you have to look at the psychology of a stressed consumer. It changes what they put in their cart. If household budgets are tight, they stop venturing into the middle of the store. They stop buying the discretionary, higher margin items, the massive flat screen TVs, the jewelry, the expensive patio furniture.
Right, they aren't buying kayaks during a recession.
Exactly. They stick exclusively to the perimeter, buying bulk groceries and raw staples, which have almost zero margin.
So the warehouse is completely full of people, but basket sizes shrink and revenue growth essentially stalls.
Yep.
So essentially, the biggest risk isn't that Costco suddenly stops being a brilliantly run company. The risk is that it's a great company trading at a really unforgiving price.
Right?
If you buy in now, aren't you essentially betting that they never stumble?
That is the eternal struggle with premium wide moat stocks. But I would counter that by pointing out the recent price action.
16% drop.
Yes. That 16.7% pullback off the May highs has already done a lot of the heavy lifting. It has already begun pricing in that sales slowdown narrative and flushing out the excess optimism.
So the risk of multiple compression is significantly lower right now at $900 than it was 2 months ago at a $496.
Significantly lower. A nearly 17% drop offers a much more de-risked entry point. And remember, the membership model fundamentally insulates them from typical retail margin compression,
Right.
which gives their stock a floor that most traditional retailers just do not have.
Okay, well, it is time to synthesize all of this research. Let's get to the final verdict. Based on the analysis, the fundamental toll booth model, the institutional absorption we are seeing on the charts, and the upcoming catalysts, the research gives Costco an 8 out of 10 bullish score.
I agree with that. It is a textbook example of a priced for perfection pullback. The underlying business hasn't broken in the slightest. The market's hyperinflated expectations just got a necessary, healthy reality check.
Which means this volatility is offering a really rare entry point into a wide moat compounder. The target horizon here isn't a quick overnight day trade, though.
No, definitely not.
The research points to a multi-year hold, suggesting this is a prime moment to accumulate shares heading into that critical September earnings report.
Short-term volatility in these massive, structurally sound stocks can very often mask underlying long-term strength.
And the whole point of this deep dive is to give you the tools to view these wild market overreactions objectively. Just because a stock's price is down on your screen doesn't mean the actual company is failing.
Right.
Sometimes they just didn't hit the ball quite far enough into the bleachers to satisfy the most demanding coach in the world.
It's a great way to look at it. And before we wrap up, I do want to leave you with one final thought to ponder, connecting back to that digital wallet we discussed earlier.
Oh yeah, the throughput thing.
We talked about how it improves physical throughput at the register. But think about the bigger picture for a second. Costco just proved it can successfully launch and integrate a digital financial tool directly to its massive, incredibly loyal member base.
Okay. Where are you going with this?
If their physical stores are basically just a break-even perk for holding a membership card,
Mhm.
what happens in a few years if Costco quietly starts rolling out exclusive fintech services?
Wait, like what?
Like high-yield savings accounts, personal loans, or auto insurance right inside that app.
Oh, wow.
With their massive scale and the immense trust they have built with consumers, you aren't just looking at a retailer anymore. You might be looking at a sleeping financial giant.
Wow. A fintech juggernaut disguised as a bulk warehouse. That completely changes how you value the company long term.
It really does.
That is absolutely something to keep an eye on. Well, thank you for joining us on this deep dive. Keep questioning the headlines, always look beneath the surface of the charts, and we'll see you next time.